Is homeownership overrated?
Brian, I'm excited to talk about this because I love that we can answer questions. I love that we get to load you guys up with financial information that hopefully helps you take your finances to the next level beyond common sense. Well, we like that we can put together content that we construct, but we also like that we can speak to the things that you care about. So right now, we have the team out in the wings collecting your questions, and we would love to answer them. We would love to speak to the things that you want to know. So with that, Creative Director Reby, I'm going to throw it over to you.
Yeah, we got a great question to start us off from Ramona. It says, almost every financial person I listen to says that buying a home is one of the best ways to build wealth. But for me, at least right now, renting is so much cheaper. Wouldn't it be better to just rent and invest the difference? This is kind of a common thread in questions that we're seeing in this current climate. So what do you guys have to say?
Yeah, I think this one's really interesting. And there, in my view, there is one word that this question hinges on. And the word was, wouldn't it be better to just rent and invest the difference? And I think the answer to your question, Ramona, depends on how you define the word better. It depends on what outcome you're looking for. Because I think we've lived in this world where it has been drilled into us that home ownership is a must. It's the only way to wealth. You have to own a home. You have to own a home. You have to own a home. And while there are amazing and wonderful benefits to home ownership, if owning a home is not part of the goals that you have or the desires that you have or doesn't make sense for your unique situation, it may in fact not be the best decision for you, especially in an environment where home prices have skyrocketed and interest rates are super, super high. So I think a lot of young people especially, they feel this pressure. I have to buy a home. I have to buy a home. I have to buy a home. I don't know that that's an appropriate and accurate pressure that everyone necessarily ought to feel.
Look, I want everybody to know, and we're about to do a net worth by age show that will confirm this. Unfortunately, most Americans' net worth is tied into their home net worth, their home ownership, I should say, the equity in their house. So home ownership is good, especially historically. However, we are in a moment where underlying value is somewhat disconnected from the timing, the ebb and flow of what things are worth. Value is disconnected from price in the current market. And let me give you some stats to set the table on this. And 47 out of the 50 largest U.S. metros, the average cost of buying a starter home, which is less than 2 bedrooms, is $2,959 per month.
So $3,000 a month on average for a start. That's a lot of money. I know that when I bought my first house, my mortgage was not $3,000 a month.
It gets even, but take this context. That is 64% higher than the cost of renting in those 47 out of the 50 largest metro communities. And then if you look at how that compares to the previous year, that's 36% more expensive than it was even a year earlier. So this is a problem. I love home ownership, but timing does matter. And if value is disconnected from what you're receiving from renting, then I think the question being asked actually has some merit to it.
And I think, Brian, tell me if you agree with this. I think when it comes to home ownership, specifically talking about your primary residence, my opinion, it's not always purely a financial decision. A lot of times we make the decision around primary home ownership based on other circumstances. Where do I want to live? What kind of family do I want to have? What do I need to be able to do those sorts of things? And it's less about, am I buying the absolute best house at the best price at the perfect best time? But even inside of that construct, you can still make wise decisions when it comes to buying a home, or you can feel justified saying, hey, maybe homeownership's not for me. Or maybe in this season and station of my life right now, I don't think that I have to go out and buy a home right now today.
Well, I think, look, I want to make sure we're very clear on this. A lot of times, because I don't want people to get confused in the fact that, because we talk about don't try to time the stock market. And timing financial markets can be tough, especially if you look at like the S&P 500. The majority of the time, markets, when they get crushed, they have what's called V-shaped recoveries, meaning that you'll hit the bottom, and then this thing will spring up. And pretty much the energy is directly impacted by the rubber band effect of how fast it goes down is also impacts how fast it goes up. Well, the problem with real estate is that there are more cycles where it's called a U-shaped recovery, meaning that you can see where things will kind of level out even in a bottom for a while. And that does allow you to kind of think more long-term. And this is, let me give you some old man advice here. I have found there's moments in my life where I've been like at a friend's parents' place, or I've been out on, on a vacation. You're like, man, I feel like I'm never going to be able to afford this. And then you find out, and fast forward, and we go through another economic cycle, and then all of a sudden there's a window where things become affordable. And you remember that feeling of helplessness that you had. So this is how this all comes together, is that just like Bo said, homeownership can go beyond your net worth statement, and it can be more of what you need as a good use asset to raise your family. But that doesn't mean you shouldn't pay attention to what the value and cost of things are right now. But I would encourage you, start having the field vision to think about, where do I want to be 5 years from now? Where do I want to be 10 years from now? What does that life look like? So that when I see the area I want to live in, when I see the type of house I want to live in, I make note and start doing the homework to figure out, this is the plan, this is the dream. Now, how do I get the nuts and bolts of the analytics to line up to where I do it? And what I have found is, I've had this happen to me multiple times. You will be able to spot, because we'll give you the tools, we'll give you even the website to go check it out, to go figure out how this pertains to your personal financial life. But you've got to do the preparation. That's what luck is. Luck is at the intersection of opportunity and then value and all the other variables that come into it, hitting at the perfect time. But what if, because you've been through this too, we've done it with commercial real estate, we've done it with residential. What can somebody who figures out, yes, I want to buy a house because this is a more lifestyle decision that will be good for raising a family, setting roots in this community so I'm not so transient. How does somebody do that well?
Yeah, we actually have a resource you can go check out. Go to moneyguy.com/resources. Not only do we have a home buying checklist that will walk you through the things you ought to think about when you buy a home. What's going on in that market? How long can I be here? What's my job security? What's my family situation like? It will walk you through the things that you ought to think through. But we also actually have a tool out on the website. Again, moneyguy.com/resources. A home affordability tool. When you put in your information, it'll say, hey, here's how much home you can afford. Here's how much house you ought to think about buying given what's going on in the current market. And then you'll have to make the assessment, okay, if I know this is how much I can afford, and I know that these are the thoughts I need to work through on my checklist, does it make sense for me to move into this transaction? And if it doesn't make this sense, and this is what Ramona was saying, hey, maybe it makes more sense that I just rent and invest the difference, I think that's okay. I don't think you have to necessarily feel that bad about that, because you would rather wait on making such a huge life decision than rush into it and make a giant life decision in a very poor manner.
Yeah, and look, if your goal is to own a house in that community in the next 3 to 5 years, start making the actions. Rent, but save the difference. And then that way, when all of a sudden we have some type of adjustment in the marketplace, interest rates go down, or some opportunity presents itself, or you get a big promotion in your cash flow, you're in a completely different financial situation. It doesn't always have to be waiting for the market to crash. It might be your situation improves. You will be ready to capture the moment, and then everybody will go, man, how are you so good at choosing? It's because I did my homework. If you guys can understand, the discipline that goes into deferred gratification is also the discipline that goes into beginning with the end in mind, so that you know all the variables that go into making big life decisions and navigating them well.
Love it.
Love that. Ramona, thank you for your question. If you would like a Money Guy tumbler, it is Tumbler Day. So if we answer your question on today's live stream, we would love to send you a Money Guy tumbler. Just email Katie to redeem that. Her email address is Katie, Katie, @moneyguy.com.
I do have a question. So because I was trying to think of when you're in big stadiums and you know, overrated, and then I was trying to do the, is my timing off?
right?
See, I was
That
off,
sounds
wasn't
right.
I?
That feels
See,
right.
that's what I figured. You
I
know,
was
this
gonna let
is
it go.
there's a reason I don't play percussion like Nate. I mean, it's you know, you don't want me setting the timing for your band. I mean, that's definitely for sure.
I still liked it.
That's amazing. I liked it.
It was
I think
unexpected.
fit.
It was
I think
fun.
worked.
I try to
Caught
keep
me
you
off
guys.
guard.
I try to keep you on your toes. I thought Bo was good, but it was a live stream. He doesn't get a take back on this one.
No, that
You
one we
can't
gotta
say
roll
start it
through.
over. All right. Ready for the next question?
I'm ready.
We got some more in the hopper here. Next up is keeping afloat's question.
Keeping afloat. That sounds nice.
It says, I recently upgraded from a jalopy to a 2022 RAV4 with 23.8 at a 6.35%. I'm saving 25% of my gross income with 4.5 months in an emergency fund. Is there any harm in paying off the car in 18 months before funding a 6-month emergency fund?
You know, that's interesting. I want to go back to make sure that I've got my facts right
Absolutely.
here. Upgraded the jalopy to a new car. That's awesome. Followed 23.8.
Yes.
So they are inside of the guidelines. They bought a car, 6.35% interest rate on the car, but
Yes.
still following 23.8. They're saving 25% for the future, and they currently have a 4.5 month emergency fund. Sounds like the goal is 6 months, right?
Yes.
So this is one of those very unique scenarios where we say, when it comes to building an emergency fund, you likely need either 3 months of expenses or 6 months of expenses if you're not retired, or somewhere in between based on your unique circumstance. And it sounds like keeping afloat is defined. I need the 6 months in there. I love hearing that you've already hit that first threshold. You've already hit the threshold of having 3 months and you're working towards that goal. So then the question is, hey, is there anything wrong with me paying off this auto loan in 18 months as opposed to 36 months? I'm going to be honest. I kind of love the idea of that because I would argue at 6.35%, even following the financial order of operations. Brian, do you have the thing that you can hold up and show? Even following the
almost threw my pen
financial
across the
order
room.
of operations. And if you don't know this, we have the financial order of operations. That's a 9-step, tried and true process of what to do with your next dollar. You can go get your free laminated copy, if you laminate it, at moneyguy.com/resources. I would argue that 6.35% car loan probably classifies in the higher interest rate category. Like, I think it's still, that might be there in that 3. Again, you have to kind of define for yourself based on your dollars where that's at. I personally would not have a problem with them pursuing both of those goals at the same time, or even aggressively getting the car paid down while they're building from 4.5 to 6. Agree, disagree, want to fight?
I actually no, I'm that's not bad advice. I think it's good. It's just, but I will say that keeping afloat, you're so close, 4.5 to 6 months. Make sure you're not skipping this step to figure out, hey, how hard would it be to replace my job? Because that's really what a larger emergency reserves is tied to, how much income you make and how hard it'd be to replace, and then how much of a pickle you would be if you were unemployed for an extended period of time. And maybe this is the CPA in me, I like, instead of going to extremes, one, either option A or option B, I kind of like, hey, is there an option to do all the above? Because that was always my favorite answers when you're going through multiple choice questions. I just like saying all the above. So, because why couldn't you potentially have 80% of whatever your excess is go towards paying down the 6.35% car loan, but then maybe 20% is going to keep going to your emergency reserves. That way that spread, because if you're making 4.5 to 5% on your cash and you're paying 6.35, if you have the lion's share going to extinguish that debt early, I love it, because that is a higher interest rate, but it also allows you in the background to have a little nudge going towards raising that emergency reserves. But I'm not going to get mad if you pay off 6.35 on a depreciating asset like a car loan. You're crushing it, keeping it afloat. So I congratulate you and love that you're truly a financial mutant out there thinking about these type of things.
I love the thought process that keeping afloat did all the thing. Followed 23.8, hitting the 6 months, following the food, saving 25, doing all the stuff you're supposed to be doing. So kudos to you, keeping afloat.
Awesome. Keeping afloat, if you would like.
Yeah, because
you have more to
he's
say?
even doing the Roth. He's doing the Roth and the retirement because he's doing greater than 25%.
He's saying 25%. Like,
yeah.
he's kind of like, yeah.
He's got
Once you
some
get over
options.
25%, I mean, that's where I give people a lot of latitude to just what helps you sleep better at night and live the best version of the life you want to live.
Yep.
Absolutely. Keeping afloat, if you would like a Money Guy tumbler, we'd love to send you one since we answered your question today. Just email Katie to redeem that, katie@moneyguy.com. All right, Michelle G has a question. She says, should you try to catch up on missed savings if you drop down to steps 1 to 3 of the financial order of operations for a significant period of time? Or just get back to saving 25% and move forward? For context, she said there was a job loss and starting a business. So it was just one of those messy middle things. And she now finds herself on these early steps of the FOO. So how would you handle that and think about that?
Did she say how old she was?
You know, she did not. Michelle,
Okay.
if you're there and you want to give some context, feel free.
Do this for me, Bo, to set the table.
Yeah.
A lot of people, because I've been watching a lot of YouTube because that seems to have replaced all my streaming services. And there's so many people out there that are selling courses and other things that feel disjointed just for the sheer purpose of just, this is the way these people make a living. But we've actually created tools and resources both on the free side, but what can somebody like Michelle G, to know where she is, tell them the purpose of every one of the things that we have on the website.
Yes, if you go to learn.moneyguy.com, you can look at some of the curriculum that we've built out. And when it comes to your financial picture, we really want you to have this idea of knowing, where am I today, where am I going in the future, and what are the steps to get there. And we've built sort of 3 tools that you can use to do that. The net worth tool will tell you, okay, where am I today? What does my current financial situation look like? The Know Your Number course will help define the finish line. Where am I going? What am I moving towards? And the financial order of operations gives you the pathway. How do I get from where I am today to where I want to be in the future? Michelle's question is, hey, I had a setback, I missed. Should I just get back to 25% or should I go try to make up for lost time? I think there are more questions you have to answer to know what the answer is, because it may be, 25% won't get the job done for you.
Yeah, we
You
don't
gotta
know her
say more.
age. We don't know how far behind she
Yep.
is.
Or it may have been, hey, you know what? Life happens, but you're young enough, you have plenty of time. If you can just get back to 25%, you're still going to be on track. You're still going to be on pace. I just don't think I don't think she's correctly defined those variables.
Well, and that's why I went back to the learn.moneyguy.com. It's not just to sell products. It's because I think a lot of people, we were trying to think of how can people accelerate their journey. And somebody like Michelle, who had to take a step back, you don't know if you're behind the curve, if you're on the curve, or you're ahead of the curve. And the only way you're going to be able to do that is you have to take some type of metric to figure out what can 25% do for you. Now, if you'd given us a few more variables, we could guesstimate. Like if you're a 24-year-old writing this question, Michelle G, I'm going to tell you more than likely it doesn't matter
just
if you
get
took
to
a step back.
25%.
However, if you're 43 years old and you took a decade long where you had to take a step back because life just happened and some other messy middle things put you backwards, 25% likely might not be enough to get you where you need to be. So that's why I throw out the resource of going to learn.moneyguy.com so you could figure out, hey, what is the Know Your Number? So you can figure out, because not only will it tell you where you are, but it'll also say if you just save a little bit more, if you save a few $100s more a month, it's going to reach this goal faster. If you change this assumption on rate of return, if you change this assumption on inflation, it's just one of those great things to hopefully help you accelerate your path towards abundance. And that's been the motivation for everything we've done. But by all means, keep taking advantage of all the free stuff at moneyguy.com/resources as well.
Love it.
Michelle, thanks for your question. If you'd like a Money Guy tumbler, we'd love to send you one. Just email Katie, Katie @moneyguy.com, and we'll work on getting that sent out to you since we answered your question today. All right. Next up, we've got a question from the Aging Ascetic. It says, I have a friend who wants to buy a house with some friends, and I know that could be a disaster if things go south. I have tried to explain why it's a bad idea, but I'm struggling. Can you explain it?
Is this to live in or is it investment? Do we have context?
I took it as living in. Because let's be honest, housing prices and market is crazy right now. So that could be one way to achieve.
I've been counseling young folks on this, right? They're like, hey, you got to think about what are some creative ways that you could get into how, like what, in my mind, I was thinking like duplex house hacking, but some of the people have said, okay, what I'll do is I'll just get 3 or 4 of my buddies. We'll pull our resource. We'll go out and buy a house. And while that sounds great on paper. I do think if you were going to try to pursue that, there are a lot of pitfalls that should go into that. Because when you buy a large asset with someone, even if it's going to be your primary residence, you're basically going into business with that person. You are basically, essentially, marrying that person, at least as it relates to that piece of property, that thing that you're committing to. So you better make sure that you are on the same page, not just about what day one will look like, but also day one through whatever day that you want to exit. And then you have to make sure on the same page about what does exit look like. And in my opinion, for folks that are doing this just for the sake of getting into a starter home, just for starting out, it seems to me that a lot of that could go very wonky and very awry. Now, Brian, you've never done this with a primary residence, but I am curious. You bought a rental property with some other individuals. Did you find that it was like a super easy, seamless, not a difficult thing to navigate, or was there stickiness that, like, man, not only was that hard on an investment property, boy, if we were sharing a bathroom, it'd have been even worse.
Well, here's the reality, because I did buy a beach rental with CPAs, dentists. I'm trying to think of some of the other positions, these professionals. I knew some of them. I didn't know everybody that I was essentially going into the business with on this too good of a deal to pass up, which somehow the deal turned into good for everybody else too. But what I found is what you're not taking into account when you get multiple people into real estate is that life just happens. Mm-hmm. There's a lot of complexity of life just naturally. And what blew up ours is that one of the couples that we bought this rental property with got divorced.
Oh, yeah.
And there was a life situation where the marriage was coming to a close. And then this person said, hey, I just want out of this thing. So I'll let you guys buy me out at a fair price. Well, then like four other, actually it was only five of us in. So two other people then chimed in and said, hey, I want out too. Mm-hmm. You're like, well, maybe I'll just sell this thing.
Because then you have to make the decision. Do I want to sell it or do I want to buy them out?
Yeah, it was because it was one of those, but it was I was just telling you, life happens. So if you buy this with multiple people, just know that down the road that some of those people are going to get married. Some of those people are going to or maybe they're already married and they're going to get divorced. It's just going to be some weird complications of life.
What about job changes and somebody wants to move or needs to go somewhere else?
And then I was going to talk about the logistics of this too, mm-hmm. is that if you buy this where you all just go an individual name and social security numbers, buy this property, whoever's listed first, their social security number will be what shows up on the tax documents. Now, look, you all have a right to claim a portion of this on your taxes, but it does just create some weird logistics to where they're going to have to show that they're only claiming a portion of the deduction, and you're going to have to try to claim and then put the other person's social security. There's some unique things. I've done this where relatives own property like a lake house together. So then you'll say, well, let's fix all that. Let's actually go and create a partnership. Mm-hmm. Or an LLC and own it in that. Well, then now because you got multiple parties, now you've got tax returns that you'll have to do. So there's some weird tax ramifications that you can navigate, but it does add complexity of your life. And then it's just the other part is that, just be careful. It's just like you don't lend money to relatives mm-hmm. unless you're planning on it being a gift. Because things get just weird mm-hmm. sometimes when you bring money into personal relationships. What I would encourage, what I'd rather see is, I think sometimes I've heard Bo give this guidance to some of our younger coworkers, is there's nothing wrong with house hacking. Mm-hmm. And the fact that, and as a matter of fact, some of our primary advisors, when they graduate college, they had a friend who bought the condo mm-hmm. and then they lived in the condo and paid rent to the friend that bought the condo. Yep. And there's nothing wrong with y'all even figuring out, hey, how do we, if you go in this, maybe the person who's not on there gets a decent deal, better than market on the rent. But the person who's actually got the name on there and has the obligations to the financial stuff, they get a little bit of extra juice because they are having to put their future purchasing yep. power on the line for this. Have an open conversation, but I think it might be easier for y'all to figure out, hey, how do we give a good deal for everybody, but still give a premium to the person that puts their name on the line and social security number on the line? But maybe we shouldn't all, because it gets really complex, especially how do you unwind this mm-hmm. when life happens?
And I think the more people that are involved, the more difficult it is. So it's hard enough with two people. Then it gets really hard with 3, 4, 5. the more personalities, more preferences you enter the equation, the more chances you have for disagreement.
Well, inherited real estate is one of the hardest things to deal with because you typically will find people, but it makes the point of the more cooks in the kitchen, the more you're inviting more trouble because it's just hard to make the decisions, the binary decisions that need to be made when somebody needs to be the leader.
Yep.
Yeah. I think we all have this thing of like, oh, my friends will cover or they won't mind, but like you don't know what your life's going to look like in 4 or 5 years. And then what if they do mind? And then, So that was some good advice and some good ways to think through that.
And since it is like a business, go get an operating agreement created. Get an attorney involved. I know you don't want to do that because you think it's all going to be rainbows and unicorns and stuff. But no, just like when you set up a business, you need to have some discussions of, let's go ahead and pretend this is going to the pooper really quick, and let's talk about how we're going to make the decisions while we're all getting along, because you don't want to just have where you're in civil court or small claims court trying to figure out stuff. It could be a mess.
It's so fun. Like you think about like, all right, I got a 4-bedroom house and I'm in one of the bedrooms, and all of a sudden there's a problem in the bathroom, and I'm like, oh, okay, I got to renovate the bathroom. The way that I'm going to want to renovate my bathroom is probably going to be very different than the other 3 want to renovate. You know what I mean?
Yeah, and then you get into the weirdness of like maybe one of you
makes a
has
lot of money
to do it. The other one's like, well, I'm saving up for X, or I don't make as much money, and it just these are the things you can't really
turns into
predict,
a Friends
right?
episode.
It does.
Yeah.
That's right.
Yeah.
Exactly right.
Exactly. All right. Well, the Aging Ascetic, if you would like a Money Guide tumbler, we'd love to send you one. Just email Katie to redeem that, katie@moneyguide.com. Thanks for asking your question, and we're glad to answer it on the show today. Okay. Next question is from Chris H. And you're going to like this one because it's perfectly timed. He says, when is the best time to do your first net worth statement? And I mean, you guys are huge fans of your annual net worth statement. So I'd love for you to share why, like what impact that has made on your financial lives, and then answer his question, like when's the best time to do it and how should he think about doing that?
When is the best time? If you've never done it before, as soon as possible, right now, today. That's like, you got to start it. If you just graduated college and you're just coming out and you're starting out in the workforce, do it today. Get it on paper. Start it. Because the best time to start tracking it is right now today, and then you can track it into the future. I'll share what I do personally, what I know that you do personally. I like doing mine once a year. It's because I love surprises. I'm the kind of guy, Brian, like, it's Christmas time, right? And so they're boxes showing up at my house. You know what I don't do? I don't look at the boxes. I mean, I pick them up and bring them inside because, that's what I do for my wife. But I don't want to see it. I don't want to ruin. I hate ruining surprises. I love that when I do my net worth statement on like January 1st of every year, because I do it as of the end of the year, I love being surprised by what happened over the last year. And so I love doing it once a year. I like doing it at the end of the year because that way it just kind of like 12/31 is a nice solid reset to use, and then I track it every single year. And I've been doing this now for a long time, and it's amazing to look back and see where I am today versus where I started back when it probably seemed pretty silly to do a net worth statement because there wasn't a whole lot of net worth there to look at.
Look, I think there's never a bad time to do a net worth statement. However, this goes under the category of it's better to be lucky than good. I was just having a conversation with a family who'd started an entrepreneur endeavor, and they had seen my comments to Caleb Hammer about get the heck off of spreadsheets, get into QuickBooks. And I was like, and good news about the time we're having this conversation is that we're in December. And I was like, the best time to make a big transition for a business entity, and this applies to individuals too, is start of a brand new calendar year. January 1st is your friend because you get to start afresh of this new endeavor with like QuickBooks, with a business and so forth. But it's the same thing for you as an individual. How do you take the pulse or the measurement of where you are in your financial life? And a net worth is a great barometer or a great dashboard. And just like Bo said, we're coming to the close of December. So lucky you, winter chicken dinner. I screwed that all up.
Lucky you, chicken dinner.
Yeah, you know what I'm saying. But it is. Start the net worth right now at the end of the year. December 31st is going to be your friend. And by the way, we have free resources on starting a net worth statement. But also, if you really want to accelerate this journey, you can even go to learn.moneyguide.com. We have a net worth tool, which is going to, and by the way, fresh, new, improved. Everybody who, by the way, who's bought the net worth in the past, you don't even have to go buy it again. We have updated this thing to where it now goes out to 2035. We even have some tools built into it to help you migrate your data from the old version of this. It is brilliant. I've updated mine. I know you've updated yours. I would encourage everyone, if you've been waiting for the best time to start with the net worth tool so you can see the dashboard on what the change of your assets, the 3 buckets between taxable, tax-free, as well as tax-deferred assets. And there's a lot of cool features that are now built into this thing.
And I was just going to throw out there, don't do it and then just let it sit in a vacuum. A lot of times some people will do it, but, oh, great, I know my net worth. It's this number. And then they let it go away. Actually study it, look at it, say, okay, what changed over this last year? What do I need to change over this next year? Are my buckets out of whack? Is my savings percentage not where it needs to be? Your net worth statement will bring those things to light. It'll show you the debts that you have that aren't decreasing, the assets that you have that aren't growing, and it will draw your attention to it. And then if you're someone who's married or has a significant other, you can have a conversation on that. Hey, here's what we did last year. Does this align with where we ultimately want to be going, or did we go off the rails? Did we get sidetracked? That, we bought some new cars. Look at what those new cars did with a net worth statement. Is that what we really wanted, or should we have made that decision differently? And let it be a honing mechanism to allow you to make better and better and better and better financial decisions next year and the year after and the year after and the year after, year after.
Last thing I'll close it out with, I like the subconscious benefits that come from doing a net worth statement. You guys know I've talked, I don't like this trend that's out there on social media where there's people giving chants or mantras and they're saying like, hey, if you say to yourself 5 times, I need $5,000, it will just magically show up. So I'm against that stuff. But I will tell you, there is something about the subconscious and the fact that when I've done net worth statements and you notice, hey man, I'm really shocked at what's going on with some of the short-term debts. Maybe, I need to get a look on what's going on there, or maybe I don't have enough liquidity in my emergency reserves. Just by you noticing where things are a little tight or a little leaner than you'd like. I have noticed in my life, whether it's my business planning or even my personal financial planning, is that when I notate something and make a mental acknowledgement to myself, it does awaken something inside to where now as I'm working throughout the year, it is almost magical that 12 months in the future, when you update your net worth again, you're like, whoa, look at the improvements of those things. And it is something that works out in a very subtle way. If you'll take small steps today, the huge incremental decisions and the benefits, the tell that they leave behind for the long-term future and opportunity that you're creating is pretty magical and amazing.
Yep.
Awesome.
Ruby, when do you do your net worth statement?
Usually early January, actually.
Love it.
Yeah, so it's coming up.
You and John talk about it and go through it?
Yeah.
Love it.
Yes, sir.
It's a powerful communication
tool
too. We didn't even talk about that, but that's another thing. It's great for talking to your significant other about what y'all got going on.
Absolutely. Yeah. Well, I really enjoy it. It's good stuff. Okay. So that was
Chris
H. I want to make sure I got your name right, Chris, because you get a tumbler. If you would like one, just email Katie, Katie, @moneyguy.com. We'll work on getting that sent out to you.
If you would like one. Who wouldn't like a tumbler?
I know. I don't know.
You know it does 2 things, Brian?
It's almost like it's a quack, 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 quack transformer.
Tumbler and koozie combo. So if you like hot drinks, if you like cold drinks, it's got you covered. Okay, next up, we've got a question from Mojo24. It says, how do you decide what to do with large sums of money? I have about $400K sitting in a high yield savings account. I want to buy a home in the future, but my current rent is so low that I've been putting it off. So should I keep this money in a high yield savings account, or should I do something different?
Well, this is an easier problem to have now than it used to be, right? It used to be harder when you were sitting on cash because cash was trash. It was, just wasn't paying anything, Brian. You remember when cash was paying like 25 basis points, and that's if you found a really, really good payer.
That was the high yield savings accounts.
That was the high stuff. And now your cash can make over 5%. But Mojo does, or he or she does, provide an interesting quandary. I want to buy a house. I have a use for these dollars, but my time period is a little uncertain, right? So I think where my mind went immediately, and I'm curious if yours is the same, First thing you definitely have to do is you have to use the financial order of operations as your rubric. Can you hold up the thing, Brett?
Yeah.
You know, if I've got this large sum, have I done 1? Have I done 2? Have I done 3? Have I done 4? Have I done 5? Have I done those things? And assuming that you are now in step 7, in hyperaccumulation, at that stage, I think then you can start thinking through, okay, what's the best use of these dollars above and beyond the 25%? Agree with that assessment?
Well, I think immediately what came to my mind was you have to stratify your timeline. I mean, be honest with yourself, brutally honest. Is this home purchase going to occur in the next 3 years or likely? And if it's like a 75% chance that you're going to need every bit of this $400,000 for the down payment in the next 3 years, you gotta put a moat and court it off. Just protect that cash reserves, keep it in cash reserves, even though you're probably having the itch to go do something else with it. But if you need this money in the next 3 years, it needs to stay liquid. If you stratify by the fact that no, you think you've got a great, maybe somebody, because we had a house here in the community that we had. I can't remember if we had 2 employees or 3 employees that had worked through. It was somebody had a really nice like beginner home. They'd moved away and they were now renting it, but they were a couple that they weren't trying to take advantage of where market rates were or anything like that. They just didn't want to sell it because they loved this house. They felt like they might come back to the community and they might want this house back. So they were just looking for good families to rent this house at good prices. And I love that we had multiple employees that just cycling through it. But it's now we got to a point where nobody wanted it. But it is one. So you might have found somebody who's offering a great deal. They just want a great tenant to protect their house, take care of their house. So it's better than market on what you're paying for this. And you're going to be in this house for the next 5 years. Because it doesn't make sense to go buy a house at overvalued prices when you're in this under market rent situation. If that's the case, then you now have a bigger decision because you can stratify the timeline to say, yeah, this money might have a longer time horizon than what I need for liquidity purposes.
And if you do stratify it out and you figure out, oh, I do have a longer timeline, my opinion on a sum this large, let's say it's $400,000, or you said it was $400,000. There's nothing wrong. Okay, I'm pretty sure I'm not going to need this inside of the next 3 years, but maybe it's 3 to 5, maybe it's 5 to 7. I don't think there's anything wrong with implementing a low nominal dollar cost averaging strategy. So again, I'm going to use a number. Maybe it's $3,000 a month. I'm just kind of making this off on the fly, not knowing your situation. All right, I've got this money sitting in cash. I'm just going to start dollar cost averaging into a low cost index fund every month, $3,000 a month, $3,000 a month. Well, a year from now, I will have invested $36,000 of that cash, but I'll probably have a better idea of where my housing situation is. And if it still looks like it's going down the road, then I'll just keep that going on. And maybe I'll do $3,000 over the next 12 months. Well, now I've got $72,000 that I have. And you can just continue to approach it that way. Well, if you get far enough out, the money you started dollar cost averaging 5 years ago, maybe the dollars that are available today to go out and buy the house or utilize it for the house whenever that comes up. I don't think that's a bad strategy to think about when it comes to big dollars.
And also just know the why for this, because maybe you're not buying a big enough house that you need $400,000. Go back, and once again, it comes right back to full circle to the financial order of operations. What are your cash reserve needs? How much above and beyond that are you? And then even add to that cash reserves what you need for the next 3 years for this down payment. And once you're over that, then yes, you can be even more aggressive with your dollar cost averaging investment plan to kind of get the army of dollar bills working for you.
That's right.
Awesome. Well, Mojo24, thank you for your question. We'd love to send you a Money Guy tumbler. If you would like to redeem that, just email Katie, Katie, @moneyguy.com. Okay, next question is from You Can Foo It. I knew you would appreciate that. Okay, it says, what should someone do if their spouse does not agree with getting life insurance? Is life insurance 100% necessary? I'm in the messy middle. Thanks.
Well, it depends on which side of this equation they're on.
That's true. Are they the one that wants it or not? I think that I took it as this person wants it.
I mean, life insurance is one of those heavy life discussions because, I mean, let's face it, nobody likes to talk about death. And death, you want to clear the dance floor. Let's talk about some life insurance. By the way, content calendar, you guys, I love when we when we're doing our editorial calendar meetings on what we're going to do content on, I love sometimes when we can flex talking about estate planning, life insurance. But I know when we do those shows, there's only about a nickel of you that are going to show up and watch it. It's just not many of you. It's not going to be the crowd
It's not
favorite.
the most popular
So
one.
I can understand why you can foo it. This is a hard conversation. It's going to be one that doesn't. It's not a crowd favorite, but it's more of, okay, let's first figure out, is this because income could go away? You guys are very dependent upon somebody's income. And if that music stopped tomorrow, it would leave the other significant other with debts, with potentially childcare. There's a lot of obligations that would just be sitting there, and then frame it in the case of like term life insurance, to where if you're like under 40 years of age in that messy middle, for literally not much money, a nominal amount of money for the level of protection you can get on term life insurance, you could buy away that risk. That's really a pretty powerful thing. That's how I would kind of handle it, is pose it as the problem that you're trying to solve, and then how nominal the solution is compared to the catastrophic thing that would occur if you didn't have the protection.
Yeah, I'm trying to go through my mind why a spouse would not agree with getting life insurance. There's a conversation there. Hey, okay, well, tell me, why is it that you either don't want us to purchase life insurance on your life, or you don't want us to purchase life insurance on my life? If it's because you don't want me to purchase life insurance on your life because you're nervous about the incentives aligned there, it's a bigger conversation for you guys to have. So then I would have okay, what's the reason for not wanting to do it? And then let's walk through the other side of the equation. All right, and this is, I've done this to my wife. I said, hey, sweetheart, if I left this house today and I get hit by a bus, how much do you think it would take for you to be able to live the life that you want to live, replace, my income, provide for the kids, college, all that sort of stuff, so that your lifestyle would stay the same? That's not the intent, but so that you would not be left out on your own, since I am the one who works outside the home in my household. And so we kind of talked about that, and then we flipped it around, and I said, okay, well, hey, if something were to happen to you, even though your primary responsibility right now is staying at home with the kids and doing that type of work, there would be an economic hole that would exist if you were not here. I'd have to figure out how to fill that hole so that I could go out and still do my job. And so there was a number that we even assigned to that. And it was just practical. Hey, if you weren't here, I would need resources to be able to fill in those gaps. And if I were not here, you would need resources to be able to fill in those gaps. And I think once you have that conversation, I just don't know what the friction could be. I don't know why there'd be a reason to not put that type of protection in place.
Well, let me help you confuse it, because I've had a unique case in my career. What if it's the big income earner who doesn't want to buy the insurance? Meaning, what if it's the person that makes the majority of the income in the household, and they says, I don't want to have life insurance on me. How do you have that conversation?
Yeah, that's again, that's an education piece. Because someone says, I make $1 million, making up a number, make $1 million a year. Why on earth would I buy life insurance? And the answer that I would say is, hey, if something were to happen to you, your spouse, your kids, that money is no longer coming in. That money disappears. What do you want their life to look like if that happens? Well, it depends on the answer to the question. Hopefully they would say, well, I want them to still be taken care of and be able to provide for. If they say, hey, I don't care, I'm not going to be around, that's a tough place to be in. But I think as spouses, especially if you're spouses that have little people, young children depending upon you, that's a question you really need to have. And you need to have an understanding of why it is necessary. Because I think that gets into a bigger discussion, bigger conversation.
I just know, I've been managing money, doing financial planning since the 90s. And I had one case where I had a big income earner who didn't want to buy more life insurance. And we don't sell life insurance, by the way. We're fee-only financial advisors. But I definitely pay attention when I have young people with kids in the household, and you have one predominant income earner. I do recommend term life insurance all the time, because you're on this journey from building resources. Just because you have good income doesn't mean you have net worth. You just have a good income. So if the music stopped on that, it would be a dire situation. So you have to bridge the period of time while you're building the self-insured net worth to work behind the scenes. And I felt like with this individual, they're no longer a client because there were some other issues that came up, but it was a control thing. This person was like, look, I make a lot of money. I'm not going to die, so I don't need to buy this. But I felt like there was a bigger communication discussion that this couple needed on control and other things that I thought was very unhealthy. And I don't know your situation, you can foo it, but if somebody is not willing to help their spouse with peace of mind, and I don't know if I'm coloring this because I've been in a situation where somebody was trying to essentially control the situation with the other spouse, but have those open discussion, all those variables that we just shared with you. And then maybe this needs to be a bigger discussion on other things within the marriage. If you can't show the analytical need and the financial needs and the peace of mind, emotional needs, and it's still not connecting with the spouse, then you'll probably need to just go talk to somebody about how do you get on the same page to where we're all respecting each other's hopes, dreams, fears, and everything else that goes into a very effective and healthy family relationship.
And the goal for life insurance is not universal. Some couples will say, hey, if something happens to me, I want my spouse to be set up for life. Some might say, hey, if something, I just want the mortgage to be paid off, or I just want college to be covered, or I just want to replace my income for the next 3 years while my spouse figures out how they're going to do. The answers to those questions, there are no wrong answers, but you got to have the conversation so that you are on the same page with what each of your answers are. I think it's not so that you can set the person up for life and that they can just live, lifestyles of the rich and famous off the insurance. That's not it. It's understanding what the expectations are in the relationship.
That's a good point. And I mean, if you're looking at term and it's like an expense or budget thing, I mean, you'd be surprised at how low that monthly payment can be. Like it might just be like a meal out.
That's right.
That's
exactly right.
So yeah, if it comes to like, hey, this would really give me peace of mind, it would only be sacrificing like one dinner out a month. Like it's sometimes just how you frame that and like have that conversation might make all the difference too. But interesting question. I know it's not the most fun, but it's important. So thanks for asking it. You can foo it. If you would like a tumbler, we'd love to send you one. Just email Katie, Katie @moneyguy.com.
Yeah. Clear the dance floor.
Clear the dance floor. All right, let's bring the dance back. This is a little bit of a spicy question. Maybe not, but it's interesting. From Beth H. She says, is it okay to pay off the house early if we know our number and know that we will achieve it? We're currently in our mid-30s.
Hey, but no, come on, Bo. Look, I've given.
This is why I wanted to ask it.
I'll start it off, and then you can give your fighting words on this. Look, Beth H., you know our rules. We're very unique. We balance the get wealthy activities with the stay wealthy activities. And the reason we have the pre-45, I usually don't love people to pay off their low interest mortgage, especially if you guys are part of that large group of people that have mortgages that are below 4%. Because a lot of people who bought houses or refinanced their houses pre-2021 got some low interest rates out there, and you're not going to probably see that even with interest rate drops that potentially could come in 2024. You're just not going to see a 2.5-3% mortgage for quite a while. And I know how valuable compounding can be. And if you want to go to moneyguy.com/resources, we actually have a wealth multiplier tool now where you can right on the website see what does every dollar have the potential to become for you. So pre-45, you have a lot going for you, the wealth multiplier and what every dollar can become, versus when you're post-45, your money just doesn't compound as much as it does. Plus, you hopefully have made all the hard decisions in your 20s and 30s to where now paying off a mortgage from a stay wealthy makes a lot of sense, because I get sad when young people are not get wealthy. They're just trying to get rid of their mortgage as fast as possible. But you said something very valuable. You said we're already saving and investing greater than 25%. Sounds like you might have even done our know your number, where you know you're going to reach your goals at your current savings rate. At that point, Bo, I am willing to let go of the steering wheel and let this person, because I've talked to a lot of successful people that just paying off that mortgage gives them tremendous peace of mind. and they're going to do it now. And I'm perfectly, because if you go through the financial order of operations, look, you've made it through steps 1 through 8. You've done all your prepaid to future expenses and abundance goals. You've got everything set up. If you're at step 9, rock and roll. I mean, I give you permission. I think it's great. Yes, it's not a maximization strategy, but maybe it's a peace of mind strategy for that young person that's a financial mutant and trying to get out of debt.
I don't disagree with you. I don't disagree with you because you said the 25% thing. But I just want to, for Beth, I want to pose this. Now, Brian, have you ever run a half marathon before?
No.
No. By the way, I have not either. Not my thing, right? I'm not a big runner.
I've run one 5K. No, I've run probably 5 5Ks, and then I signed up for one 10K. The Peachtree Road Race didn't show up.
Well, you know what?
No,
They
I
say,
definitely
Brian
have
felt
not
like
done
he
a
had
half
to
they say
marathon.
signing up is half the
His
battle, I
answer.
think. Here's where I'm
just
going.
wanted the t-shirt.
Here's where I'm going with this, and this is what makes me really nervous about young people that do this. I love that Beth knows the number, and I love that Beth is saving 25%. I love that Beth has figured out that, hey, it looks like based on what I'm saving, based on what I've done thus far, I have confidence in where I'm going to end up. Now, here's what makes me nervous about your mid-30s. Reeb, I'm going to ask you this question. Mid-30s, like super easy time of life, super hard time of life.
It's not the easiest.
Not the
There's a lot
easiest,
of
right?
things that are pulling
A
at
lot of
you, right?
commitments, both money
Yes.
and time.
So here's where I'm
yeah.
going with this. You start out on your half marathon, and you are pacing it great. You take off that first mile, like, holy cow, 8 minutes. Okay, great. You hit that second mile. I hit 8 minutes again.
That's not a fast time, by the way.
For a half marathon?
Okay, keep going.
Megan, is that fast time for half marathon? 8 minute mile? So
Okay.
then you hit your third mile, you're like 8 minutes again. You're like, all right, you know what? I'm at my third mile. I can be a little more aggressive. I know right now, I'm pacing 8 minutes on this thing. And so you start getting a little more aggressive. And so you push that time to 7:45 for that next mile. And then like, I'm gonna do even more. And then that 5th mile, you go down to 7:30. And then what happens? Uh-oh. I knew where I was going. I knew what I was on pace for, but man, these hills got a little rough. Man, I'm having a hard time breathing. I'm having to slow down. And all of a sudden, the pace that you thought you were going to be able to keep to finish the race may not actually be the pace that you're able to keep. And so I think it's different. Again, if you're running a half marathon, that's like 13 something miles. I think if you're on mile 10, you can feel pretty confident about that last 3. But if you're still in mile 4 or 5, there's a lot of race left to run. And for someone in your mid-30s, there's still a lot of race. So even though you're moving in the right direction, you're taking the right steps, you're doing the right things, especially if you have that low interest mortgage, I get a little nervous getting too aggressive based on where the projection says it's going to take you. Having said that, if you're doing 25%, I will also put my flag next to Brian's flag. We say that saving 25% should get there. And if you're doing that, you get to choose what you do with your dollars. You get to choose if you want to prepay that mortgage in your 30s. That's just the thing that makes me a little uncomfortable.
It is one of those things. This is what's hard about what we do for a living, especially for financial mutants. You know, I am now post 45. I told y'all I wanted to have my house paid off, but that 2.5% mortgage is not, I mean, I just would rather make the 5% on my cash. And then I've told you guys, as soon as interest rates get dropped to where I'm not making more in cash than I am on what I pay on that 2.5% mortgage, I am just going to stroke a check and pay it off. So I see the relevance of your point. And I also confess that I might just pay off the mortgage pre-book launch just because I don't want I know every city we go to talk about this, they're going to say, have you paid off your house, like you mentioned in the book? And I'm just going to need to be able to say yes, probably. So I might just do it for the peace of mind of being able to tell people
For the
I have mine.
messaging.
Because I mean, I owe so little on the house now, but it's just one of those things where this is where the financial mutant really does things to you. So, but Beth, I hope we gave you enough to think about where you can kind of now hear what our general guidance, color it to what your actual life has going on when you're, you know, painting by the numbers with all the different variables to where you get to now do your masterpiece financially.
Yeah. Beth said that was nice and spicy, thanks. But truly, I think that was a good, well-rounded answer. I hope that gave you a lot to think about. And I mean, as a fellow early 30s person, like I get what Bo's saying. Like I love having a thing to shoot for, but I don't necessarily know what new goals are going to pop up as my life changes, you know, and as I get older. So I do really respect that and agree with that thought process.
I know that we're about to close or transition some things. Isn't there something going on with Reddit these days too with the Money Guy Show?
There is. I'm so glad that you mentioned it. That was something that we were supposed to mention here at the close. But truly, if you like getting your questions answered, we are doing another Q&A tomorrow on Reddit. So head over to Reddit, look for The Money Guy Reddit thread, and Bo and Brian are going to be there tomorrow afternoon, I believe at 1 p.m. Central on Reddit. And they're going to be answering your questions in a Reddit forum. It's something new we're going to try. I'm really excited about it. We've got a pretty active Reddit community over there.
Excited.
So it's going to be good.
If y'all are curious, Bo can type faster than me. We've actually tested it.
Do we need to get a typing scribe for you?
And he keeps taking forever.
We actually tested it. He's faster. I'm willing to admit.
That's fine. You don't have to be super fast. Just
can we dictate
share the knowledge?
Can we like have typers that type for us?
I mean, if you really want to, we can grab someone.
What's it called in court?
Transcribe.
A transcriber?
That's not what it's called. What's it called in court?
Oh, like a court reporter? No.
A stenographer.
Stenographer.
Is that right? You guys in the chat, let me know if that's right. Or
that is having to do with typing.
Stenographer.
Yes.
Oh man, I hope that's not wrong because I said it on the internet.
I take pride in my consistency and accuracy.
That's what
it is.
I grew up in the time where you actually had to pull out the white strips and on the typewriter and hit the back button to fix the mistakes. So I'm very deliberate in making sure we're accurate.
I played with my grandpa's typewriter.
Cute.
Pulled out of the box. You probably didn't even play on the typewriter. You played with a word processor.
I actually played with my grandma's typewriter too. Come to think of it, I did when I was younger.
It was always so hard.
I thought it was so like novel.
Thing where you made because I never could hit it in the exact same spot.
I'm so old that they actually had typewriters in school.
No,
in high school. That's what I took typing on. I took typing on a typewriter.
What? I guess that makes sense, but that's crazy to think about.
Guys, I was watching Love Actually, and every cell phone that they were using was because that movie's from 2003, are those little Nokia, and I was like, this is all because it was 2008 when the iPhone came around, and it's just so funny how fast things have moved, even in my lifetime.
Mm-hmm.
True that.
I'm excited about the next 50.
But yeah.
Oh, heck yeah.
But yeah, I mean, we love answering your questions, and join us on Reddit tomorrow. Are you laughing at the way the threads that we follow?
Tangents.
Well, if you want more tangents or just more financial questions and answers, Reddit tomorrow, 1 p.m. Central. The Money Guy thread.
Bo will be on his computer. I'll be on a typewriter over here and then handing my notes to
That's
whoever.
Right.
Where do I plug the cord into this typewriter?
How funny would it be if I'm reading and then handing it over to somebody to input it in? Or hold it up in front of a camera.
Yeah, we live stream his typing.
Take screenshots of
it. She's going to hate that I asked this question live on the air. But I'm going to. Can we should stream us answering. Like we should stream us answering the Reddit thing.
Underestimate how boring that would actually be to watch.
Well.
Like they don't know what you're answering. It's just you typing.
That's a good point. That's fair.
But we will be live streaming again. Actually, I didn't even mean to announce this, but not next week because of Christmas.
Oh, we're not doing
But we'll
next
be back
time.
in the new year every Tuesday, 10 a.m. Central.
Love it.
Yeah, we do have a special treat next Tuesday, though,
We
for
do.
everybody who wants to show up.
Yeah.
Though.
So stay. We'll still have something really good for
run
you.
this thing like a business. We want to keep you coming back on
Listen,
Tuesday.
I don't know.
We've
gone
special.
off the rails. I didn't mean to announce that at all, but it's true.
Awesome.
We have something great coming for you next Tuesday, and then the new year
wait,
will
I
be.
just realized what it was.
You don't think it's good?
It all depends about how much razzle-dazzle the editing team puts into it.
Dying. Okay. But no, we actually have some great stuff planned for you for the holidays. So even if we take time off, there will be plenty of content here on YouTube and at moneyguy.com. And then we'll be kicking it off strong in the new year with some of your favorite episodes. So I will give that little teaser too.
Yeah.
But thanks for being here today.
Merry Christmas. Happy New Year. We'll see y'all in 2024. I'll do it like it's like elementary school. See you next year.